What shaped markets today wasn't just price action, it was a shift in expectations around the Fed pivot. Yesterday, the market bet that the Federal Reserve would look through the energy shock. Today, that optimism collided with the reality of a physical supply-side crisis. The relief rally we saw on Wednesday proved to be short-lived. Markets sold off broadly today as the focus returned to a relentlessly climbing oil price. The DOW was the primary victim, dropping over 1/6 its worst session in weeks as industrial stocks buckled under the weight of rising input costs. The S&P 500 fell about 0.5%, erasing most of yesterday's gains, while the Nasdaq showed some resilience, down only 0.3%. The broader story was written in the volatility index. The VIX surged 12%, reclaiming almost the entire fear premium that had been unwound just 24 hours ago. In the commodity space, crude oil gained nearly 6%, pushing toward $80 a barrel, while gold and Bitcoin both edged lower as investors prioritized cash liquidity over traditional hedges. The primary driver today was a transition from headline risk to structural blockade. For 5 days now, the Strait of Hormuz has remained effectively closed. We are seeing a shift in market psychology. Investors are no longer viewing this as a temporary spike, but as a sustained removal of 20 million barrels of oil from the global daily supply. This was compounded by domestic data. New labor statistics show that hourly compensation is surging at an annual rate of nearly 6%. This creates a double whammy for policy. The Fed is now facing supply-side inflation from oil and demand-side inflation from wages simultaneously. The soft landing window isn't just closing, it's being bolted shut by rising costs. Today's capital flow was a retreat into what we call inelasticity. Money moved into energy, the only true hedge against a blockade, and selectively into mega-cap tech. Institutions are effectively hiding in the two extremes of essential now, which is oil, and essential tomorrow, which is AI infrastructure. Conversely, we saw an aggressive abandonment of industrials, materials, and small caps. If a business relies on a global factory or a shipping lane, it was sold today. This suggests that institutional investors are de-risking from anything with high operational leverage to global trade. The market is now positioning for a stagflationary corridor, slowing growth matched with sticky, supply-driven inflation, while the headlines are focused on oil. There is a systemic risk building in the shadows of the market. The collapse of maritime insurance. Global trade doesn't run on ships. It runs on the ability to insure them. With insurers withdrawing or risk coverage for the Persian Gulf, shipping rates for certain tankers have jumped from $40,000 to nearly $300,000 per day. This creates a shadow inflation spike that won't show up in official government data for months, but it is currently breaking the just-in-time manufacturing model. If these logistics costs don't normalize, the industrial sector may be facing a much deeper earnings contraction than is currently priced in. Today marks a definitive regime shift from financial policy to physical reality. Yesterday, the market was debating whether the Fed wanted to cut rates. Today, the market realized the Fed cannot cut as long as the physical supply of energy is being strangled. The mirror pivot we discussed yesterday, the idea that the Fed would look through the crisis, has been effectively neutralized by the reality of the Hormuz blockade. The next phase of market direction hinges entirely on tomorrow's non-farm payrolls report. It has become a double-edged sword. If the jobs numbers are strong, it proves the economy is resilient, but it also guarantees the Fed stays hawkish. If the numbers are weak, the market will likely pivot into immediate recession fear. We are also watching for any signs of contagion in private credit. With software valuations under pressure and interest rates rising, the liquidity in private funds is becoming a focal point for institutional stress. Strategic takeaway for investors: the Miran rally was a false start. What this suggests for investors is a need to prioritize inelastic assets, companies with massive margins and direct commodity exposure, while avoiding the operational trap of industrials and materials until the maritime insurance market stabilizes.